Hey there, money-savvy friends. Welcome back to our Dividend Dynamos channel. Ever heard of dividend investing but weren't quite sure what it meant? Well, you're in for a treat today. We're going to explain dividend investing in simple terms. By the end of this video, you'll have a solid understanding of how it works. If you enjoy the video and find it helpful, make sure to give it a thumbs up and subscribe to the channel for more content. And as always, I encourage you to comment below with your thoughts or any questions you might have. I love hearing from you and engaging in discussions about these topics. So let's dive right in and explore the world of dividend investing together. First things first, what exactly is a dividend? A dividend is a portion of a company's profits that it pays out to its shareholders. Think of it as a reward for investing in the company. It's like getting a slice of the company's success pie. Now let's talk about how often dividends are paid. Most companies pay dividends quarterly, which means 4 times a year. Some companies pay monthly while others pay annually. The frequency can vary, but quarterly payments are the most common. Dividends can be issued in various forms such as cash payments, additional shares of stock, or other property. Here's a more detailed breakdown of dividends, including how they work, why companies pay them, and what investors need to consider. The declaration date is when the company announces its intention to pay a dividend, specifying the amount, the record date, and the payment date. This is often done during a company's board meeting. The record date is when shareholders who are recorded in the company's books as of this date will be eligible to receive the dividend. This is usually a few weeks after the declaration date. The ex-dividend date is typically set 1 business day before the record date. If you purchase the stock on or after the ex-dividend date, you will not be eligible to receive the dividend. This is because stock transactions settle on a T+2 basis, meaning 2 business days after the trade date. The payment date is when the company distributes the dividend to eligible shareholders. This is the day when you actually receive the cash or additional shares in your account. So how do you actually get these dividends? When you buy shares of a dividend-paying company, you become eligible to receive dividends. The company will announce a record date for each dividend payment. If you own shares on or before this date, you'll receive the dividend. Let's look at an example to make this clearer. Say you buy 100 shares of company XYZ at $50 per share. XYZ pays a quarterly dividend of 50 cents per share. This means you'd receive $50 in dividends every quarter. 100 shares times 50 cents. Over a year, that adds up to $200 in dividend income. Now you might be wondering, why would I choose dividend investing? Well, there are several benefits to consider. First, it provides a steady stream of income. This can be especially helpful during retirement or when you need extra cash flow. Second, dividend-paying companies are often stable and well-established. They tend to be less volatile than growth stocks, which can offer some peace of mind. Third, dividends can help offset losses during market downturns. Even if the stock price drops, you're still earning income through dividends. But like any investment strategy, dividend investing has its drawbacks too. One potential downside is that dividend-paying stocks might have lower growth potential. Companies that pay dividends are using that money to reward shareholders instead of reinvesting in the business. Another thing to keep in mind is taxes. In most cases, dividends are taxable income. The tax rate can vary depending on whether they're qualified or non-qualified dividends. So how do you get started with dividend investing? First, do your research. Look for companies with a history of consistent dividend payments. These are often called dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Next, consider the dividend yield. This is the annual dividend payment divided by the stock price. A higher yield might seem attractive, but be cautious. Sometimes a very high yield can be a red flag, indicating the company might be in trouble. Don't forget to diversify your portfolio. Invest in different sectors and industries to spread out your risk. You might also want to look into dividend reinvestment plans, or DRIPs. These plans automatically reinvest your dividends to buy more shares. It's a great way to compound your returns over time. Remember, dividend investing is typically a long-term strategy. It's about building wealth slowly and steadily over time. Let's talk about some popular dividend-paying stocks as examples. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble are well-known dividend payers. They've been increasing their dividends for decades. But don't limit yourself to individual stocks. You can also invest in dividend-focused mutual funds or exchange-traded funds, ETFs. These offer instant diversification and professional management. As you build your dividend portfolio, keep an eye on the payout ratio. This is the percentage of earnings a company pays out as dividends. A very high payout ratio might not be sustainable in the long run. As a general rule of thumb, I like to see the payout ratio under 75%, and the lower the better. It's also important to monitor the financial health of the companies you invest in. Look at factors like debt levels, cash flow, and overall business performance. A company needs to be financially healthy to maintain and grow its dividend payments. Lastly, don't forget about dividend growth. A company that consistently increases its dividend can help your income keep pace with inflation. This is why many investors focus on dividend growth stocks rather than just high-yield stocks. Look for dividend aristocrats, companies that have paid dividends for 25 years or more, or dividend kings, companies that have paid dividends for 50 years or more. And there you have it, folks. That's dividend investing in a nutshell. We've covered what dividends are, how they work, and why they might be a good addition to your investment strategy. I am not a financial advisor, and the content of this video is for entertainment and informational purposes only. The opinions and information shared here are based on my personal research and experiences. Always remember that investing and financial decisions involve risk, and it's crucial to do your own research and consult with a qualified financial professional before making any decisions. Remember, like any investment, it's important to do your own research and consider your personal financial goals. Think of this video as a conversation between friends where I share my thoughts and insights. My goal is to provide you with interesting content and ideas, but ultimately, the responsibility for any financial decision rests with you. If you found this video helpful, please give it a thumbs up and subscribe for more financial content. And hey, let us know in the comments if you have any questions about dividend investing. Thanks for watching, and here's to growing your wealth one dividend at a time.